One of the growth areas for our firm has been working with younger people who are working in private equity and venture capital. These professionals have rather unique circumstances with their income and wealth accumulation that requires very specialized planning. For example, one of our clients expects to receive significant income over the next few years in the form of carried interest. While carried interest gets favorable tax treatment, essentially treating performance-based income as investment gain rather than compensation, the amounts can vary rather significantly year to year. Hi, I'm Zach Palmer, Certified Financial Planner with Ark Royal Wealth Management. If you work in private equity or venture capital, chances are you've got a high variable income, you're working long hours, and probably don't want to spend your limited free time juggling tax planning and managing your personal finances. If that's you, stick around as I share 3 ways we help clients in the PE and VC space, plus a bonus tip at the end that's often the real difference maker. And by the way, if you invest in real estate funds, a lot of these same strategies will apply to you as well. One of the biggest strategies we use is tax loss harvesting, both in-house and through separately managed account vehicles, or SMAs for short. Why does this matter? Because many of our clients receive carried interest or realized gains from outside private investment funds. That often means large, unexpected tax hits. Tax loss harvesting allows us to offset some of those gains by intentionally realizing losses in other parts of the portfolio. Here's how it works. Let's say that within your investment portfolio, you have some holdings that have unrealized losses. We sell that position or lot, capturing the tax loss, but immediately reinvest in a surrogate fund or holding that closely mirrors the original investment. Think of it as selling Coke and buying Pepsi. That strategy results in a win-win. You avoid the IRS wash sale rules and capture a capital loss you can apply against carried interest distributions to reduce your overall tax. It also keeps your account invested in the market at all times. The tax code allows you to apply losses to offset gains, and if losses are greater, apply up to $3,000 of losses against ordinary income. If any losses are left over, they are saved and applied against gains in future years. This is known as tax loss carryforwards. Let's walk through an example. Let's say we have a client in New York earning $1 million annually. That puts them in the top federal tax bracket plus New York state tax. Call it a combined rate of 48%. They have a taxable investment account with us of $1.5 million. On April 2nd, 2025, President Trump announced the so-called Liberation Day tariffs, and the stock market subsequently declined about 15% over the next few weeks. During that time, we identified $200,000 of unrealized losses in the portfolio. By strategically selling those positions and immediately buying surrogate funds, the client realized $200,000 of losses, and since the client's overall account remained invested, they actually achieved a positive return in line with the market return so far year to date. That $200,000 loss resulted in roughly $96,000 in tax savings. That's real money that would have otherwise gone to the IRS. So, while clients focus on co-investing in their next deal, our goal within the portfolio we manage is to deliver strong returns and proactive tax benefits. Margin accounts often sound intimidating, but when used responsibly and tactically, they can be one of the smartest tools for high-income PE professionals. Here's why. They provide short-term bridge financing. For example, let's take a client in California in the highest tax bracket. They've committed $500,000 to an outside co-investment, but their liquidity event won't hit for another month or two. Instead of selling securities at a large gain, which would trigger unnecessary taxes at rates that can exceed 50% in California, we borrow against the portfolio using margin. When their cash flow comes in, we pay off the margin. This way, the client gets the liquidity they need without creating a taxable event. It's a great example of how using the right tool at the right time can keep more of your money working instead of going to taxes. Another challenge for private equity professionals is the tax bill itself. With variable income, it's easy to get caught short when those quarterly or year-end payments come due. We solve this by creating a dedicated liquidity fund, earmarked specifically for taxes. Typically, we'll place this in a money market account. Why? Because it's not exposed to market risk, it earns more than sitting idle in a business checking account, and importantly, we don't charge a management fee on these dollars. Keeping the liquidity fund in-house provides us visibility and further takes the burden off the client. This way, clients have peace of mind knowing their tax obligations are covered while their other assets are fully invested for long-term growth. Finally, here's the bonus, and really the most critical piece: having a coordinated team of professionals working for you. That means your advisor and your CPA are in the loop, collaborating on your behalf. Too often, professionals operate in silos, but when we work together, we can proactively plan for things like retirement contributions, setting aside funds for taxes, and structuring your investments to your advantage. The feedback from our private equity clients who've leveraged all 4 of these tips is that it is a huge time saver for them, provides them peace of mind knowing they don't need to be burdened with every little detail, and they can stay focused on their career. If you're in private equity, venture capital, or even investing in real estate funds and looking for a partner to help you outsource your financial complexity, let's talk. Thanks for watching, and I'll see you next time.
If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.